to today's Business Tools series video. This is part of a series under the Business School for Architects that you can find at school.com/archibiz. Check out the Business School. It's where there's lots of resources and lots of discussion about the business side of architecture. So in the last video we spoke about the profit and loss account, which is a record of income and expenditure over a period of time. It can be a week, a month, a year. Typically, often in architectural practices, we only look at our profit and loss once a year with our accountant, and we would advocate very much that you bring that to at least a monthly basis so that you know where you're winning and losing, where you're making profit and not making profit. So moving on from that, today we have the other biggie in accounting, which is the balance sheet. And there's often a huge confusion between the balance sheet and the profit and loss account. So let's today look at what is a balance sheet. They're very different. Profit and loss and balance sheet are actually very different. And the definition of a balance sheet is a financial snapshot of a business at a point in time. So what is the financial position of the business right there at a point in time, and how has it changed over time? So where a profit and loss is income and expenditure, this is at a point in time, where are we at? And today I'm going to take you through a very basic balance sheet, but most in principle are the same. So balance suggests that there are two sides, and there are indeed assets, things that we own, and liabilities, which are money that we've got to pay at some point. And the assets and liabilities are again split in, if you like, balance, top and bottom. And on the asset side, we've got what we call current assets. And they're called current assets because they are available to us as cash very quickly. So that's cash in the bank, or debtors. Debtors being the money that people owe us. And that gives us a total current assets number of 214,000 in this business here. Then we've got fixed assets. So these are the things that you can't turn into cash very quickly. This would be things like property, cars, office equipment. These are your fixed assets in the business, and these are typically depreciated over time, so that the value that's represented in the balance sheet is actually the money you would get if you actually sold that item or that asset today. And depreciation brings down the cost or the value of an asset over time. So your balance sheet should always, this is a key point, the balance sheet should always represent the real value of the business today. Okay, so we've fixed assets of 560, add the 560 to the 214, and we've got total assets of 774,000 pounds, dollars, whatever. Balance sheet looks the same the world over. And then we come to the liabilities, and in the same way as we have current assets, we've also got current liabilities, and these would be things like our creditors. So if debtors are the money that's owed to us by our clients, creditors that's the money that we are owed to the people that we bought services from, or anything that we bought. We need, if we haven't paid that cash, then we will have a creditor at a point in time, money that we're due to pay. Bank overdraft. We need to make a distinction between bank overdraft and loan, because in most jurisdictions a bank overdraft can be called in by the bank. It's not a solid loan agreement that's signed up with the bank. It's a loan to you for a period of time. But if your numbers don't stack up and then you start losing money or whatever, the bank might get a bit edgy about your overdraft and reduce your overdraft. That can happen in business. So sometimes you're better with a long-term loan rather than a bank overdraft, but that's obviously a separate issue. And then you've got things like tax. GST is goods and services tax in Australia, could be value added tax in the UK, it could be wages tax or whatever. And that gives us a current liabilities of 140,000 here. And then in the same way as with fixed assets, we've actually got non-current liabilities or long-term liabilities. So these would be things like a property mortgage, a car loan, 5-year business loan. They will make a distinction between the business loan and the overdraft. Really important to remember that. So if long-term liabilities of 350, current liabilities 140, the total liabilities 490,000. So now we've got two numbers. We've got a list of assets on the left-hand side of the balance sheet, broken down by current and fixed assets. And on the liability side, we've got current liabilities and non-current liabilities. And the net of those two numbers, 284,000, is the net worth of the business. Now, in my world, a good balance sheet will always be a balance sheet that represents what I would call the close the door number. Okay? If you stop trading tomorrow and you sold all your assets and you collected your debts and you paid your bills, that's what will be left in the bank at the end of the day, 284,000. That's why we depreciate fixed assets. That's why we try and keep the balance sheet as accurate as possible. And what I find is that people don't look at the balance sheet. The accountant will look at the balance sheet. In fact, an accountant probably looks at the balance sheet first before they look at the profit and loss. Profit and loss being about trading, balance sheet being about the worth of the business now and how much actual value is there in the business. Now, there could be a discussion about things like goodwill in the business, which is called a non-tangible asset, but I don't want to complicate things today by speaking about that. You can put a value in goodwill. If you're selling your business, the price that you get may be the asset, the balance sheet value, plus some consideration for goodwill. But in terms of looking at the business at a point in time, this is what I would, as I said earlier, the close the door number. There should be $284,000 left in the bank if your balance sheet is accurate. Now, one last thing I would like to draw attention to are these two numbers here. So this is the current liabilities and the current assets. And the first thing that a bank, if they're lending you money, will look at is actually these two numbers here. This is what they call a very important ratio. And what we're looking for is the current assets to be higher, if possible, than the current liabilities. Because if the current liabilities are higher than the assets, the chances are we've got a cash flow problem. We're looking to collect money very quickly to pay bills that were due last week or the week before, and that's not a nice position. We want to have enough what we call working capital in the business so that everything flows. You've got the money to pay your bills, you've got money to pay wages and all those things. So keeping an eye on this ratio, how much am I owe short term and how much can I turn into cash in the short term, a really, really important ratio. So that in essence is the balance sheet. Two sides, top and bottom, current assets, fixed assets, current liabilities, non-current liabilities, and a net worth number. So if you understand the distinction between the profit and loss and the balance sheet, then you're well on the way to understanding your finances. It's not that complicated, but typically we don't. As I said in the last video, it took me a long time to make this distinction. No one saw fit to explain them properly to me. So there you go, that's the explanation. I hope you enjoyed this video. I would encourage you to check out the Business School for Architects at school.com/archibiz, ARCHIBIZ. My name's Ray Brown. I'm the CEO of Archibiz, and I look forward to seeing you in the next video.